No one sells whole life insurance except insurance people. No one believes in it in the financial planning arena that doesn't sell it.
Dave Ramsey's fired up. Welcome back to Finance Zoom. Today, I'll dive into why Dave calls whole life insurance a scam. It's been a hot mess for decades. Only insurance folks push it. And the smart money? They steer clear. Stick around. I'm about to expose the whole truth. According to Ramsey Solutions, whole life insurance stinks. Insurance companies market it as an awesome product that lasts your entire life. They call it permanent life insurance. Then they dress it up with things like fixed premiums and cash value accounts to lure you into buying a policy. The statement from Ramsey Solutions is crystal clear. Whole life insurance is far from awesome. It's marketed as a lifelong solution, but often becomes a poor choice. With enticing features like fixed premiums and cash value accounts, it might seem appealing, but it's often a bait and switch. It's crucial to be cautious when considering such policies. Let's start by understanding what whole life insurance is all about. Whole life insurance is an insurance policy that combines insurance coverage with an investment component. It's often sold to provide for your family and build cash value over time. Sounds great, right? Well, let's dig deeper. Let's focus on why whole life insurance is a scam. Hear this out.
It goes to build up a cash value inside the policy, which for the first 3 years is zero. What do you call that? Front-loaded heavy commissions. I mean, if it's a $100 a month premium, that means that they are collecting almost $4,000 worth of commissions before you make a dime.
Here's why I believe whole life insurance is a scam. Number 1, you'll pay a higher premium with whole life insurance. Dave Ramsey astutely points out a concerning aspect of whole life insurance. You'll face significantly higher premiums than term life insurance. These premiums can be astonishingly high. Each month, a part of your premium goes toward covering your life insurance costs, while the rest is stashed away in a cash value account. But here's the catch. The allocation of your premium changes over time. In the early years, a substantial percentage is funneled into the cash value, while as you age, more goes toward your life insurance coverage. Dave Ramsey's perspective aligns with many financial experts who believe that whole life insurance, with its cash value feature and exorbitant premiums, often doesn't serve individuals seeking financial security. It's essential to recognize that those who most vocally endorse it are usually profiting from selling it, not necessarily those who prioritize your financial well-being. When you're forking out those hefty premiums for whole life insurance, a significant chunk of your money ends up in the insurance company's pockets, covering fees and commissions rather than substantially boosting your coverage. Remember, it's a financial decision that warrants careful consideration. With that context in mind about the cash value that grows very slowly over time, here's Dave.
The average cash value policy will yield you, net of all expenses, 1.2% on a whole life policy, 3.6% on a universal policy, and 4.3% net of all expenses. Now, they'll quote you 10 and 12 and all this other crap on a variable life. And so it's a horrible rate of return for long-term investing. Absolutely horrendous rate of return on long-term investing.
Number 2, your cash value grows very slowly over time. Dave Ramsey clarifies that cash value policies don't offer strong returns. On average, after all expenses are factored in, whole life policies provide a meager 1.2% return. Generally, universal policies offer 3.6%. The best case scenario with variable life policies is 4.3%. This begs the question, why to pay so much for a cash value account with a low interest rate? These returns are far from impressive when compared to other long-term investment options. Simply put, your money could grow much more effectively elsewhere, making these policies less appealing for those seeking solid long-term investments. The returns on the investment component are abysmal. If you were to invest that same money in other vehicles like stocks or mutual funds, you'd likely see much higher returns over the long term. Your insurance company offers an unimpressive interest rate on your cash value account. This cash value is meant to grow slowly over time, similar to a savings account. When you accumulate some savings, you can borrow against them or leave them alone, but both options have downsides. There are two possible outcomes. You'll reach maturity age, typically around 120 years old, and can access your cash value savings, or more likely, you'll pass away before maturity, causing your cash value to vanish. In this case, the insurance company keeps it. Your family receives the death benefit, but your cash value account goes into the insurer's pocket. This is one of the significant drawbacks of cash value life insurance, reinforcing why it's often advised to avoid it. Lastly, the insurance company's lack of transparency is a concerning issue. Hear this out.
If you have a $200,000 whole life policy and you end up with $50,000 in there after you get past those zeros and the horrible rate of return, and you finally end up with $50,000 in your $200,000 cash value policy and you die, you know what they send to the beneficiary? $200,000, the amount of the insurance. What happened to your investment? Well, they keep it. So you have a savings account where the first 3 years they keep all your money. After that, they pay you 1%. And after that, when you die, they keep your money. This is a horrible savings account.
Number 3. The insurance company's lack of transparency is a concerning issue. Dave Ramsey highlights a critical issue with whole life insurance: a lack of transparency. When you have a $200,000 whole life policy and end up with only $50,000 in cash value after the initial zeros and pitiful returns, you'd expect your beneficiaries to receive that investment upon your death. However, that's not the case. The insurance company keeps your money. This lack of clarity and misleading terms make whole life insurance a terrible savings account and a financial trap. It's a stark reminder of why understanding the fine print is crucial in financial planning. Whole life insurance policies are notorious for their complexity. Understanding how your money is being invested is often challenging, and the fees can be hidden in the fine print. Now, you might wonder, why would anyone push whole life insurance if it's such a raw deal? Well, that brings us to the commissions and incentives. Financial advisors can earn hefty commissions by selling whole life insurance policies, so it's in their best interest to promote it, even if it may not be your best option. So, what should you do instead? I'm glad you asked. First, prioritize getting term life insurance. It offers your family the essential protection they need while minimizing costs. The savings can then be directed toward investments with better returns, such as a diversified portfolio of low-cost index funds. Second, empower yourself with knowledge about personal finance. Never solely rely on the guidance of others, even when they are as respected as Dave Ramsey. Remember, it's your money, and you must assume control of your financial decisions. Lastly, remember that financial freedom comes from making informed choices about your money. It's about tracking your finances, making wise investments, and aligning your financial decisions with your long-term goals. You can build a solid foundation for financial security and independence by staying informed and proactive. Remember, your choices shape your financial future today, so make them wisely to secure your desired life. To sum it up, whole life insurance may not be the scammiest scam, but it's certainly not the best option for most people. So, what do you think about whole life insurance? Have you had any experiences with it? Dave Ramsey's unwavering stance on whole life insurance is crystal clear. It's not a prudent financial choice for most individuals. He champions responsible financial planning, founded on sound mathematics and independent thinking. If you've ever encountered an insurance agent promoting whole life insurance with misleading information, it's imperative to proceed cautiously. Their credibility becomes questionable when such inaccuracies come to light. Within this realm of insurance sales, we encounter two distinct types of agents: those who knowingly promote a questionable investment, prioritizing their profits over ethical considerations, and those who, perhaps unwittingly, lack a comprehensive grasp of the underlying mathematics or choose to overlook financial realities. Whole life insurance often functions poorly as a savings vehicle, and it can be likened to a middle-class payday lending scheme. Given these considerations, I strongly advise against both selling and purchasing it. Instead, I encourage you to explore the merits of term life insurance and make well-informed investment decisions. This approach is instrumental in securing a more prosperous financial future for you and your loved ones. Remember that your financial freedom is contingent upon making informed decisions about your money. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.